Welcome. It is with great pleasure that I open this event of the Green, Social, Sustainability, and Sustainability-Linked Bond Principles that we have designed with a specific U.S. perspective. Sustainable finance is one of ICMA's four key areas of focus, and sustainability is increasingly integral to everything we do. We are privileged at ICMA to be the stewards of global standards for green, social, sustainability, and sustainability-linked bonds, collectively referred to as sustainable bonds, that are referenced by more than 95% of international issuance in this segment. These standards have been developed with the input of a wide market initiative of more than 400 organizations and stakeholders under the auspices of the Executive Committee of the Principles, supported by ICMA and currently chaired by the IFC. The international sustainable bond market is in a renewed growth phase, with combined volumes this year reaching $630 billion as of end August, surpassing already last year's total of $589 billion. While the market is on its way to another record year, some even anticipate it could reach the landmark of $1 trillion by end 2021. US firms have always been at the center of developments in the sustainable bond market, whether it is through their contribution to the elaboration of its voluntary guidance or their participation in its governance structure, and of course, through their direct participation in the market. Nonetheless, we find that there remains for many an information gap on some of the important aspects of this market. So I'm going to take you through a short presentation before we move to the panel. So in this presentation, I'm going to take you through some of the key aspects of this market. Firstly, we have a family of principles which refer to the different type of guidance that is available in the market for specific sustainable instruments. There are three sets of principles for use of proceeds bonds, and these are the green bond principles, the social bond principles, and the sustainability bond guidelines. And for general purpose bonds, but with sustainability targets at the organization level, we have the sustainability linked bond principles. We also have overarching thematic guidance for both types of bonds through the Climate Transition Finance Handbook. We are often asked, are these principles really a global standard? What you can see in the slide is indeed they are. 95% of issuance globally refers to the principles. In this slide, I want to take you through the 2021 update of the Green Bond Principles. Firstly, we have elevated two key recommendations for bond frameworks and external reviews alongside the four core components. We have recommended heightened transparency for issue-level sustainability strategies and commitments. We have encouraged information, if relevant, on the degree of alignment of projects with taxonomies. And we have promoted transparency on issuer processes to identify and manage perceived and known social and/or environmental risks. Now, I already referred to how these principles are elaborated, but I wanted to come back to that point. We have a market initiative of more than 400 organizations internationally, representing all of the key participants and stakeholders in this market, and they are broken down between members and observers. There are many US organizations that are, of course, part of this market initiative. This is a very structured initiative. The members that I was referring to in the previous slide elect each year an executive committee with equal representation of investors, issuers, and underwriters. This group elects a steering committee, which is currently chaired by IFC, and with two vice chairs, Crédit Agricole and BlackRock. So it is this group that provides leadership to the market initiative, particularly with respect to the elaboration and update of the principles. Now, I wanted to finish with a quick overview of the market, particularly from a US perspective. I've referred to the fact that we're going to a record year. We might hit 1 trillion by year end. Currently, we are at over 600 billion of issuance. What you can see on the left is that US issuance in this context has been stable at about 15% last year and year to date. If you look at the graph on the right-hand side, what is interesting is that the US market is following the international trend, where we see significant diversification at the instrument level. So in green, we have the green bonds, which continue to be, the most important part of issuance, but we also have in orange, yellow, and in dark green, the social sustainability and sustainability linked bonds. And so the trends, again, that we see globally is reflected in the US. With that, I'll end my presentation. Coming back to our event, you will see in today's agenda that we have a great panel moderated by Ashley Schulten, Managing Director, Head of Responsible Investing for Global Fixed Income at BlackRock, and who is also a member of the steering committee of the principles. I'm sure that you will all enjoy and learn from this important event. So now, without further delay, it's over to you, Ashley.
Great. Thank you, Nicholas, for that great presentation. And thank you for the support that ICMA has shown the development of this market over the years. So as mentioned, the last few years, we've seen a really strong acceleration in the take-up of this market in the fixed income space. As you mentioned, now the green bonds alone sitting at $1 trillion outstanding, the social and sustainability bonds over $500 billion combined. We're seeing more and more large sovereign issuers enter the space, and now even the emergence of a sustained, what we call Greenium, which we'll talk about. I'm joined today by a panel of veterans in the market, all of whom are active in the green and social bond principles. So starting with Lisa Bozzelli on our panel. She's the Senior Director in Fannie Mae's Multifamily Capital Markets Group, part of the green financing team there, which has been issuing green commercial MBS for almost 10 years. She's responsible for the issuance of the structured REMIC offerings and the Fannie Mae GEMs. So Fannie Mae, they've issued more than $13 billion in green GEMs backed by multifamily green MBS. She's also one of the year's newest executive committee members after serving on our advisory council. Kedish Pothingham, he's an executive vice president in the London office of PIMCO, a portfolio manager focusing on UK credit investing in the European Portfolio Management Group. He's also a member of PIMCO's ESG team and is PIMCO's elected representative on the ICMA Green Bond Principles and Social Bond Principles Executive Committee. He also has over 34 years of investment in financial services experience. You've seen a lot, Kedish. Steve Nichols also on our panel. He's the head of ESG Capital Markets for the Americas for Bank of America. In this role, he's responsible for supporting the firm's capital markets franchises by providing corporate clients with advice on how to navigate the ESG investor landscape. He's raised over $120 billion in ESG-themed capital since he joined Bank of America in 2019. And in addition to that, he's actually been on the other side of it. He's actually been an issuer in this market. In 2015, he led some of the very first corporate bonds in the US, a $1 billion offering from one of the nation's largest electric utilities. So welcome to our panel. I'm really excited for our conversation. I'm gonna ask us to talk a little bit about the tremendous growth in this ESG labeled market, and really, share with us now, what do you think is the most interesting trend or topic that you personally are focused on? What's been the biggest surprise for you, good or bad, and where do you see the upside and also perhaps the risk? I'm gonna first turn this over to Stephen.
Thank you, Ashley, for the great introduction, and to the rest of the panelists for joining us as well, and to ICMA for organizing this great event. Really appreciate the audience members attending too. For me, the most interesting trend has been the expansion of ESG labeled products into high yield and convertible bond markets. The traditional ESG themed offerings in the US in particular have been almost exclusively investment grade over the course of time. But I think that expansion into high yield and convertible markets offers a real impact opportunity because often the issuers in that market are a little bit less mature, they're further upstream in the value chain, and they're developing technologies and business models that we need to see succeed if we're going to limit warming to 1.5 degrees. And so I think that trend hopefully will bring some new investors into the fold, and I'll also obviously offer opportunities for a lot more issuers as well. For me, the biggest surprise, I would say, has been the change in the attitude of the corporate clients that I talk to every day, from call it 2018, 2019 to today. When I first moved from the issuer side to the underwriter side of this market, a lot of our issuer clients were almost tired of hearing about green bonds. They had been pitched green bonds multiple times over the the last several years, had sort of decided that there wasn't enough benefit to them of accessing the market to justify the work to do it. And I would characterize their question as basically saying, tell me why I should do this. And today, that has totally reversed to be, please help me figure out how to do this. How can I make this kind of offering work for my company, given the sustainable investments we're making and the overarching ESG goals that we have? It's maybe not a surprise to me that that attitude did eventually change, but how fast it's changed has definitely surprised me and pleasantly surprised me. And then lastly, to your question about where I see upside or risk, I think actually that change in issuer client attitude and rapid growth of the market is actually where there might be some risk embedded here. So I think we've all seen articles about the race for talent in this space, in the sustainable finance arena. And I think that race for talent, the growth of the market, is starting to put some strain on the system, potentially with bankers like me, with SPO providers, even on the buy side, folks struggling to find people that have the right kind of expertise to maintain some sort of quality assurance in this market. And I think personally, the benefits of the market growing and expanding absolutely outweigh the downside of maybe a few less than stellar transactions coming to market. But I think it's incumbent on all of us, especially those of us that are on the executive committee, to make sure that those trades don't end up establishing a precedent that others will follow.
Yeah, thank you, Steve. And agree with you on that high yield point. It's it's really interesting as companies move, from early stage VC, into private markets and evolve, and maybe are entering the space. The high yield market might be an opportunity where we're seeing some of that move into maturity. And then also on the point about the talent, I mean, who would have thought, 10 years ago we'd be hiring climatologists, at asset managers. So Lisa, what about you?
Sure, no, definitely. I think to build on what Steve was saying, it is exciting to see the diversity of assets that are coming to market. For what we're working on right now, we're very focused on our single family housing green program. We launched this effort last year. We've issued about 400 million of single family MBS that are backed by Energy Star certificates, so new construction. But how do we deal with older existing stock? I think the multifamily sector is a commercial, right? Commercial entities are owners. They have existing reporting systems in place. So the much larger residential market poses more challenges, just like these other asset classes that Stephen referred to. But it's also a huge opportunity. I think biggest surprise, I'm not afraid to admit that I was a little skeptical about the pickup of the sustainability linked bonds. I thought the structures might be too varied or too bespoke for investors. So I was very happy to be wrong about that. I think that market has hit, over 30 billion so far the first half of the year. And then I would say upside is the amount of focus that we've seen here in the US in the past 18 months from even traditional financing sources on carbon reduction. It's heartening, makes you feel good that there's so much more focus on it. When you have a non-agency CMBS underwriter trying to implement an energy efficiency program, you really know that times have changed. And to Steve's point about the market needing more labeled programs from different asset classes, we need that other capital to help these other assets, right, beyond agency money and agency assets. And then risks, honestly, I think the biggest risk I think about is really not being able to hit our goals in climate. And I think that's on everyone's mind as we try to develop these programs and do what each of us can do as an organization. And then I'd also say the other two big risks for me are around data and modeling. And I think that's kind of a global issue.
Yeah, good to remember that perspective of why are we all doing this in the first place. Kadish, over to you.
Hi, Ashley. Yes, first of all, thank you to ICMA, the other panelists, and also to those listening. So I think there are two things to raise about the market, where it's come from and where it's going. Is first of all is the impressive size. So as Nicholas summed up at the start, we've had nearly 700 billion year to date, which is a record year. Quickly passed last year's number, which was also a record year. And this is really talks to the need for sustainable finance and the availability of private money coming into this area. And then if you think of, say, the growth of people looking to invest So, we are, as asset managers, asset owners, want to be seen to be investing in sustainable products. And this is where, say, the dangers or the positives lie. And the dangers is that the robustness of the products and the robustness of the standards that are employed. So we really focus on frameworks when we talk about green bonds, and we want the issuer to have an alignment with, say, Paris, or have their overall business model moving in the right direction. We think that that's very important, and that sort of rigor is very key going forward. Otherwise, you lose credibility as a product, and then that really starts impacting on the future viability of the whole sustainable finance area. And then I think the positives are that the number of sovereigns coming to the market, who are now realizing that, say, the green bond market is open. And as a result of it, that means that their transparency, their openness is increasing as well. And it demonstrates their commitment to this cause. There are a variety of estimates as to how much finance is required, for example, to hit the UN Sustainable Development Goals. But let's say it's in the trillions of dollars per annum. This growth of the market suggests that the money is there to fund that change.
Yeah, certainly a good sign. Yeah, and I think, a point you make about this idea of greenwashing that we hear in the markets, and maybe something why, green bonds give you that transparency and that type of reporting that can help us defend against that. Lisa, I want to circle back on, one of the points you made. I think in sustainability circles and thinking about taxonomies, one of the thornier things that we struggle with is this standard around buildings energy efficiency. I know there's been debates in all sorts of circles around this. You have different buildings in different jurisdictions. A building in, Ohio in the US is different than a building in Germany, that's different than a building in Africa. We've kind of coalesced around this idea of top 15% in your region, et cetera. How should we be thinking about building standards? What are your perspectives on this? Maybe different building labels for between one jurisdiction and the rest?
Sure, no, definitely. And I think, when you mentioned building labels, I think most people are familiar with certifications, so green building certifications. A lot of US folks are familiar with the US Green Building Council's LEED certification. I think that was one that I hear most commonly referred to, or the UK's BREEAM certification. So essentially, these were both started in the 90s, BREEAM, I think early 90s, and LEED late 90s. But they really focus on a building's design, construction, and operation as a whole package with certain requirements. And that's where the nuance comes in, is what are the requirements that the different certifications require. We have a green building certification program, but we are very focused on energy and water consumption reduction. So we select only those certifications that kind of meet that requirement. But I think people oversimplify the world. Each of these certifications have, multiple subcategories. So for example, on our list of even just the acceptables, it's 13 organizations, each with multiple certifications and each with different levels there. So it becomes a very complicated topic, but it is one that the market does seem to be most comfortable with, because there is that rigor that Kedish talked about, that an outside entity is supervising the rigor of that program. You had mentioned the top 15% in energy performance, and that's a real challenge for us. It's mentioned in the EU taxonomy, along with the green building certification concept. But the challenge is, where do you get that 15%? So in our sector, for apartment buildings, owners don't often have whole building utility data, right? Tenants are often separately metered, they often pay their own bills. So the big challenge is, how are you going to compare all of these buildings in all these different markets if you can't even at the base get the raw data? So we're hoping that this may change over time, but currently what we do is we partnered with the EPA and use the EPA's portfolio manager tool. So essentially, we ask the borrowers in the green program to enter their energy data into the system, and that produces a 1 to 100 kind of benchmark exercise. Again, not perfect, but it is the tool that we have available currently. But I would caution, as we talk about folks and they're looking at 15% top and LEED certification only as their level, I think, if that's really where you're looking, there are social implications to making those judgments. To say that the U.S. housing stock is seasoned is kind. In our affordable housing and our workforce housing portfolio, they're generally not newly constructed buildings. They're 40 years old. They're in desperate need of energy and water efficiency improvements. So I think a majority of our bonds and green financing are in our green rewards program, which is that in-place retrofit, with requirements for a 30% energy and water consumption improvement over 12 months. Now, the expert group for the EU taxonomy also picked up on this requirement. They also have a 30% requirement. Theirs is pure energy. And I think that what you need to do is, as you're building these programs, and on the investor side, as you're looking at programs, you do kind of need to figure out, where are you going to draw the line? Is it going to be only the pure that get the certification, or is there also the idea of transitioning this older housing stock, which is a burden to climate, on that forward mobility pattern? And then lastly, I would focus on ask folks to focus that these are commercial entities that we're talking about for the most part. So they do need to make sense, these improvements. We're asking for extensive improvements, and they are expensive. And so I think that 30%, when people ask, why can't you do more than 30%? We really got there with data in terms of the energy audits that we have and the cost per door that we're asking these borrowers to make. And does it make economic sense? Because I think if you raise that bar too high, then you just won't get any flow.
Yeah, certainly interesting perspective. Stephen or Kadish, any other projects that you're seeing come in the market that we feel like there might be some controversy around? I know we see some headlines on a day-to-day basis about this new technology or that. Anything that highlights to you of where you think there might be debate in terms of inclusion in use of proceeds categories or KPIs, et cetera?
So just briefly on that, it's quite a challenge to have diversification in green bonds, in the context that not every industry has a green project to finance. And I think this is where the development of the markets has been positive, in that, say, we now have a different type of instrument called sustainability linked bonds, which allow companies to use a general proceeds approach to improving behavior in their overall sustainability sustainability of their businesses. And we think that this is a positive development. It doesn't usurp or in any way replace green bonds. It sits very comfortably with them, but it offers companies which won't necessarily have those projects an avenue within which to finance themselves, but also commit to improvement in overall sustainability metrics. The obvious example are utilities, where you commit to improving percentage of renewables in your install capacity. And that's a well-trodden path now. A number of utilities have done that. But also you then start seeing other companies doing similar commitments. So food companies have started doing it, apparel companies have started doing it in the context of their transportation. And it's always, Ashley, you and I talk about this a lot at XCOM. It's about the framework and the credibility of that framework, the willingness to have an annual progress report, to have a second party opinion, and also credible targets installed in your framework, which means that then people start actually believing your commitment, and it's also out there to be inspected. And I think that's the key. We don't want to look for controversy. And I think because there's so many people focused on this, controversies tend to get phased out quick before they actually hit, which I think is a good thing. And the establishment of the principles by ICMA means that people have that guidance. And also the fact that, we talk about them every week or every month where you review as an XCOM means that, say, this is a regular review process as well.
Yeah, moving over to Stephen, but I know that there's so much dialogue that happens between the issuers, the underwriters. Kadish, you and I, with talking to issuers who come and ask questions. What do you think about this project, that project? But Stephen, what's your perspective on this?
Well, it's my point I was going to bring up is closely related to Kadish's, actually. So I was going to talk about some of the debate that has existed for years now about sustainable sourcing, and whether sort of operating expenditures versus CapEx, can and should be eligible in these kinds of issuances. I definitely understand I understand both points of view. OpEx typically not a driver of long-term bond issuance, but it is a use of cash. I can say it's a use of my proceeds to go procure a sustainable item, right? And from my perspective, I always think about, when I get the question from a potential issuer, is project X or type of project Y an eligible use of proceeds, I always come back to the impact reporting. and can you quantify or at least credibly estimate the impact of what you're doing in the real world? Like not some sort of theoretical impact, but can you measure the greenhouse gas reduction, reduction in energy usage, et cetera? And from my perspective, as long as issuers can measure and report on those kind of metrics, the supply chain, procurement type of activity should remain eligible. And I think it's particularly important in sectors where the impact of their supply chain far exceeds the direct impact of the company's operations. I did want to also note that I do think that some of the newer ESG themed products that are being developed will help to sort of lessen some of the debate on this topic. Sustainability linked bonds, I think, can be a great tool there as well, because there may not be, there oftentimes aren't direct kind of CapEx investments in those supply chain oriented businesses, but a target around sustainable sourcing, for example, could be a good fit in a sustainability linked structure. We're also working on what I think are some pretty interesting ideas in the ESG themed commercial paper space. And I think that from a corporate finance perspective, there's an attraction to having that kind of working capital type of instrument that can help fund those sustainable procurement activities too.
Thank you. I love your point on the impact investing. So, getting to a point where the numbers can speak for themselves rather than qualitative judgments. Kesh, I want to circle back with you. You had mentioned some sovereign issuance. We're seeing some really high profile deals come. I think yesterday we had a $100 billion order book for a $10 billion UK green gilt. So there's certainly demand on this. Sovereigns coming to the market, having a little bit of different frameworks. How are you thinking about how these frameworks align with, sort of these global accepted frameworks that we've sort of been endorsing for years? Do you see that there might be different, themes emerging globally by different issuers?
So first of all, I think as I said when we first started talking, this is a really positive sign in our view. We think it has to be encouraged because it does signal commitment. It signals that sovereigns are willing to have targets set. They want to be willing to be inspected, and they're also willing to follow frameworks. To your point about frameworks, if you look at, say, the rate of issuance is increasing post-pandemic. The developed markets have tended to focus mostly on green bonds, whilst emerging markets focused on, say, both green, social, and sustainability linked bonds as well as SDG linked issuance as well. And in the context of, say, the emerging markets, financing gap between, say, to actually meet the SDGs means that, say, there's probably more likely they'll issue more social and SDG linked bonds and, say, than green bonds, for example. However, for the most part, sovereign have followed global standards such as the ICMAs, that there have not really been any exceptions to that rule. Second party opinions have been sought from well-regarded entities, and they're clearly defined use of proceeds. And you can see that the credibility of the UK framework stood out. It was a good framework, but it's not unique by any stretch. But all sovereigns, there is reputational risk if you don't have a decent framework. And that willingness to have that framework inspected by investors before they go into buying that is demonstrated by the fact that the demand is significant. As you rightly say, there was 100 billion demand for the UK green gilt yesterday. I think Spain and Germany have had similar responses in terms of size of demand. And we think that this is all positive, and we also think that, say, this is a development which will continue to grow. How many more sovereigns are going to come? Difficult to tell. I can't see why, if you have commitments towards Paris, we have COP26 coming up very soon, and you'll see a number of nations will reaffirm their commitments to Paris. That means that, say, it makes eminently good sense to start issuing some of your debt in the form of green bonds.
Yeah, certainly helps us as we construct global ag type portfolios.
Yes.
On that note, think about, about having public bodies issuing into the space, thinking about public involvement and, say, public sector involvement, to say regulatory support, things like green bond labels, et cetera. I mean, Lisa, you're as close as we've gotten right now in terms of US type issuance. Be curious how you're thinking about how regulation can help support this market, where it intersects the private markets conversation that's been so supportive of the growth of this market.
Sure. So I think, when you looked at the US compared to Europe over the past few years, and as you mentioned earlier, we've been in this market for 10 years now. Really in the US, it was private market driven, right? It was the pull of investors and the push of issuers who had their own programs. And there was very little regulatory involvement. And I think we've seen over this past year with the SEC's RFI, our own regulator, FHFA, had an RFI around climate risk and climate risk disclosure. I think you're going to see a lot more happening in the next year. I think there are opportunities. Obviously, I mentioned data earlier. I think data is a fundamental level at which we can start this kind of involvement. But I think you're going to see it a broad influence in the market, which hopefully is going to be helpful for everybody. Obviously, there's always concern as soon as we talk about regulation that it might stymie growth. But at the same time, it's a balancing act for them as well as for us on the issuer side.
And then maybe moving over to Steve and thinking about that growth and, where, all of us have really been involved in this market where it started 6 or 7 years ago in real earnest, in earnest growth. And I think if we had asked ourselves, 7 years ago, if we thought we would be where we are today, this would all have been a dream, and that's, coming to fruition. And back then, we had a lot of leadership out of Europe and out of the supra space. And now that's growing. We have corporate sovereigns. So what do you think, Stephen, the next 2 to 3 years is going to take us? Where are we going to move globally? What kind of sectors are we going to see? Any expectations for growth, et cetera?
Yeah, it's, I'm happy to look into my crystal ball and obviously welcome comments from the other panelists here too, because I think we all have maybe a little bit different perspectives on the market and potential for for growth among different issuer types. Maybe I'll start with a couple comments on the sort of corporate or private sector in the U.S. I think we're destined to see continued diversification of the types of issuers we have there. I was looking at some data earlier this morning, and in 2018, 100% of issuance out of the corporate private sector in the U.S. was either from a financial, a utility, or a REIT. That's down to about 2/3 more recently. So starting to see more issuance out of the tech sector, obviously, retail, consumer goods, et cetera. I think that's certainly going to continue now that we've had a few issuers. A lot of corporates in the U.S., right? They like to see someone else in their sector sort of test the waters first, put a structure out there, have the transaction go well, get actual live feedback from investors. Also, judge the press reaction too, because I think that is one of the biggest fears of potential issuers in this market, is that they do the next deal that generates those negative headlines, and then that their CEO and CFO are calling them saying, what have you done to our ESG reputation here? So I would personally forecast that REIT and utility and financial market share to continue to decline. I'm just going to put it at, call it 50% by 2023. I think we'll also see growth in sustainability-linked bond issuance in the U.S. I think it's notable that in particular in the investment grade space, we've had very little here. Just starting to see that. We have a few additional sustainability-linked bonds from investment grade corporates in our pipeline. Obviously can't comment further about those, but we definitely will see that continue to grow. I think the SEC potential disclosure regulation on that could be a significant catalyst for growth in that market. One of the things that I think has been holding that market back is lack of audited or externally assured data from US issuers, which is a stark contrast to European corporates, for example. I think it's also notable that that kind of regulation could help with impact reporting on the use of proceeds side too, because as we have to get better data, it will help. Better data from a corporate perspective will then also help with better data on more of a project or use of proceeds level as well. Would also forecast continued development of ESG structures that meet a wider variety of corporate finance needs. There's a new working group that I think a lot of us will be part of on XCOM this year that's working on development of new tools in securitization, commercial paper, even equity space. So that's an exciting development. I think you'll see some certainly interesting things out of the U.S. on the equity side. And then lastly, I have to comment on the municipal market. I think we already see a number of investors that are active in U.S. municipal transactions in what they might call or refer to as an unlabeled green bond or unlabeled social bond, because they know that the program that's being invested in has environmental and or social impact to it, but it might not carry a specific label. I think there's a lot of opportunity in that market for green issuance with a climate adaptation theme, and then social as well, obviously, given the nature of the social programs that state and local governments run. And so I'm very bullish on increased, ICMA principles aligned issuance out of that sector as well.
Great to hear. And, I think it's an interesting point about the ESG data disclosure. I'm sure that, the issuers that you talk to, they hear from green bond investors, we want more impact reporting, we want our disclosure. It doesn't exist in a vacuum. It's in the context of all of us asking for more ESG information from the parent, to begin with, in terms of a, whole push towards sustainability. Kesh, I want to move over to you and think about, okay, we have these instruments, we've issued them, we have this market that's growing, and then, we think about how are we using these? Why are they helpful in fund construction? What kinds of funds you're putting them in? How are you using them in your day-to-day investing?
Sure. So I think that's a sort of two-part answer to that question. So first of all, like yourselves, PIMCO has got designated type ESG products, which are labeled ESG products, and as such, the focus is going to be, we don't have specific green bond funds, but we have funds which are ESG labeled, which have the same benchmarks as, say, the non-ESG label, but they have a degree of rules which apply to there. And as you can imagine, say, when a new issuance comes from green, you're going to see those funds participate depending on the assessment of the framework. We keep on going back to this idea of the framework, but it's so important. And I think to Stephen's point is that labels don't necessarily confer virtue. It's so much about the context of the issuer and the nature of that issuance, which is as important as being called green or not being called green. So yes, so dedicated portfolios will of course be looking at these, but then one can see the reason. So if you look at, say, more and more asset owners are asking us about our ESG scores and how the portfolio stacks up from a carbon intensity perspective. Do we have green bonds? Do we have a percentage? And we don't have a specific percentage in non-labeled ESG products at PIMCO, but we do look at these in the context of, is there value in this versus other bonds? Does the spread stack up? And I know we'll be talking about the Greenium a little bit later. Does the spread stack up versus other similar issuance, which is not labeled? And is it worth going into the portfolio? And does it have the potential to outperform existing debt? And should we be switching out of that existing debt into new debt? So it arrives in a whole variety of portfolios. So it's not just purely dedicated ESG labeled portfolios where this arrives. This will be sitting in across funds. And I think one of the good aspects of that is that then all your PMs, all your portfolio managers are thinking about this product in this sense as well. If you think that, say, ESG sits very comfortably in the context of, say, risk assessment anyway, be it E, the S, or the G, these are all contributory factors towards, say, whether or not that risk that you're taking in that company is going to be rewarded by the spread, and you should be assessing it in the context of credit analysis. We have our own ESG scoring at PIMCO, and that's designed to give us a view internally of how an issuer stacks up. And that's given by our credit analysts because we believe that that's where it should sit. And I think that means that, say, wide involvement of the firm is a natural outcome. And frankly, I think that's a genuine positive across the piece.
Super interesting, yeah. And in that conversation around, for labeled versus unlabeled, even within the labeled, this is this voluntary label. How are we ensuring that even the labeled product that we buy is actually meeting the standards that, we've laid out in these guidelines? And, one of the things that we all talk about in I think the green bond community is this use of second party opinion providers. Right, and so there's some guidance, and we've recommended this in the ICMA principles. There's a number of these groups that are emerging that will provide sort of not necessarily a stamp of approval, but an evaluation of the green use of proceeds, the structuring, and green bonds. So I'd be curious to hear, from our group here, what's the view of the second party opinion providers? Are these necessary? Do we see more of these groups growing, especially in the U.S.? Lisa, maybe I'll start with you.
Sure. So I think, from an issuer's perspective, the external reviewers can be extremely helpful. We have a green bond frameworks reviewed by Cicero and our sustainable bond framework reviewed by Sustainalytics. And although those two, made up about 46% of the external reviewer population last year, it is still a very diverse group of opinion providers. And then from an issuer's perspective, especially if you're new to the market, I think, in your setting up your framework, the feedback process is really valuable. These organizations, generally have a deep bench of, for example, climate science professionals, which to your earlier point, the job market is highly competitive. And so you've got a lot of issuers who maybe don't have that depth, and they can you need a critical eye to look at your program from that perspective. I'd argue that investors also have a benefit to these reviewers. I'm completely speaking for Kedish now. And I loved how he said labels don't confer virtue. And it is a challenge for investors. An SPO may not be a one-stop solution. They still do have to understand each of the second party opinion providers' processes, their ratings, but it goes a long way in determining if the issuer is complying with their stated alignment and goals. So if the issuer says it's doing something, at least having a second party opinion is another set of eyes to provide feedback for the investors as well. Whether it should be part of a requirement for green bond issuance, as Nicholas said this morning, and you had just mentioned, we published the updated GBP this year, and we made it now a key recommendation. I think we're very comfortable with the key recommendation status, because I just think that it is transparency is what I would say. Transparency saves us, right? There are some folks who maybe at this stage in their program don't have the ability to do a second party opinion on their program. But again, if they follow the principles, if they have everything out in terms of transparency, then it is enough information or a lot of information for the investor community to pick up. And I think as the market continues to mature, maybe you do see this transition to a requirement at a later date.
Yeah, and Stephen, you're on the sort of the front line of this, of deciding who direct issuers to, what opinion party providers, how much they cost, what they add to the cost of transaction. And then, you pointed on something earlier, which I've heard a lot of, is backlog. So not having enough of these providers and having to wait in the queue for them to opine on it. What are your thoughts on this?
Yeah, it's a tricky one. I think in general, the second party opinions provide a lot of valuable information. I can say personally, from having worked with issuers as they go through the process, I mean, we've done it dozens of times now, right? Their feedback is valuable in helping to strengthen the framework. I'll call it at least 3/4 of the time as we go through the process. And if nothing else, it helps to kind of clarify the intention of what we were trying to get across, but maybe those of us who were too deep in the weeds on the project didn't communicate very well in the drafting of the framework language and the eligibility criteria, for example. For me, I really struggle with making them mandatory. I'll speak to my own personal experience as an issuer. This was, of course, in the very early days of the market back in 2015, but we were doing a green bond for utility scale wind and solar projects, and that was it. It went towards $1 billion, went towards 3 very large renewable energy projects. And, I sort of I got asked in the process of marketing that transaction, like, did you think about a second party opinion? And I used to sort of make the joke, if you need someone to tell you that utility scale wind or solar project is green, like maybe you should get a different line of work. And so we chose to go forward with an external review of the allocation of our proceeds, right? To basically confirm that the projects to which we allocated met the criteria we'd laid out in our offering document. And I think there's a lot of value, a tremendous amount of value in that rigor from a an individual issuer's governance perspective, but also from a market governance perspective and helping to ensure the credibility of the market overall. So I always, find myself wanting to make sure that that part of the external review process doesn't get lost and gets the, the attention that it deserves. Because I can also speak from an issuer perspective, and in my, on my corporate side, but then also from Bank of America and the process that I've watched our treasury and accounting teams go through to get our green, social, and sustainability bonds reviewed by our auditor. It's rigorous. It is a lot of work, and I think there's a lot of value to that work too.
Yeah, thanks for that. And Kedish, over to you. Have to have, some better than others. Your thoughts on second party opinions?
So our thinking is that it's not a requirement right now, and I think that's fair. But ICMA's principles are fairly clear. We encourage, when we speak to issuers and when we speak to arrangers like Stephen and both Lisa, we're going to be saying to them that we want a standalone bond framework. We want to have a second party opinion, an external review. And that's very much in keeping with the principles. We note that, say, in the US, you're seeing more and more US issuers doing exactly this. That the bond framework is established in a timely manner, and they've chosen an external reviewer, and also the use of proceeds is outlined with an allocation report as well. And that really means that progress is being made. I think to your point is that we would like to have a holistic view from the SPO. So in the context of, say, that sense of independence, that view gives you that gives it credibility, and rather than just quoting from the framework offered by the issuer. And we found that particularly useful. So in the quality, as you implied, can be different from SPOs. And I think over time, what will happen is it becomes relatively self-regulating as the quality improves. So credibility goes with that quality. So if you start slipping in that quality, then the credibility starts slipping as well. And so I think the two are closely aligned. So yeah, it's not a requirement, but it's definitely a good thing to have.
Yeah. So now we talk about, the transaction, getting closer to the transaction. That you have a second party opinion firm, you've put a framework out there. Let's talk a little bit about the transaction itself. So one of the themes that we're seeing is, allocation conversations, the allocation of green bonds differently than non-green bonds by issuers and by underwriters. Thinking about supplier diversity. So Lisa, as an issuer, are you thinking about the ESG, sort of profile of your underwriters, et cetera? So Lisa, maybe I'll start us off and hear how, when you guys allocate bonds or when you think about selecting issuers, how are you thinking about this in the green bond context?
Sure. So I think a couple different things there. I think we are working as an organization very hard to increase the diversity of the entire, mortgage market here in the U.S. Lots of ways to do that. In terms of supplier diversity, we're seeing a lot of focus even from our lender network on their own supplier diversity. And I think we've seen that, you and I both, in finance for a very long time. So we have, for example, a program called Access Program, which allows us to use minority, women, and disabled veteran-owned businesses as broker dealers on our deals. So you'll see a lot of that. And we've been working with that model for decades now. As far as allocation, we don't have the same necessarily oversubscription level problems that you had mentioned earlier. But when we do, and when we are allocating deals, we just did a green deal this past week with Bank of America, the M3G. We are very conscious working through our syndicate of what the end account is using that order for. And if it is earmarked for a green or ESG fund, similar to what Kedish had mentioned earlier, we do give preferential allocation to that. I think it's programmatically in our best interest to encourage more investor diversity in our entire pool. I think, as you know, Ashley, our regular GEMS deals and our MBS green or not green, it's still an agency mortgage, right? And so you want to get more people playing in that market. Over the years, we would have to go to the agency CMBS investors and try to sell them the green. Now we're also going to the green investors and trying to sell them the agency CMBS story. So that hits totally on Kedish's point, is every time we go to see an investor, there are those two people we have to talk to, the ESG coordinator and the PM, and it has to make both people happy to work. And so if we can get more of those folks who are ID'd as green into the book, hopefully maybe they come in for a non-green as well.
Yeah, Stephen, is that a pervasive theme you see in the green, social, sustainable linked bond market in terms of the the issuer view on allocation?
Yeah, I would say that it is. I think when I go in to talk to someone about why they should consider going through the work to do a green, social, sustainability linked bond, becoming a mouthful, but one of the things that we talk about is getting access to investors that have a focus on ESG, and they will sit up and take note of an ESG themed transaction when they might not otherwise a vanilla transaction. And if when I put myself in the issuer's shoes, if I've gone through all this work and that's one of the benefits I was hoping to get, I'm going to want to maximize that benefit when I get to the time of allocation, right? So we almost always receive instruction from our issuers to favor investors who we know to have a focus on ESG, or to have dedicated green bond portfolios, for example, in allocation of those transactions. And I think it's a perfectly kind of rational decision for the issuer to make. If I turn back to the other part of the question about ESG profile of underwriters, we are absolutely getting those kinds of questions more frequently, both from our European broker-dealer as well as our U.S. entity. I have personally spent a long time filling out ESG questionnaires for some of the really high-profile kind of transactions that we're obviously wanting to be a part of. We also are getting those kinds of questions in the process of issuers making decisions about who their relationship banks will be overall, not just about who's going to underwrite a specific transaction. So, we obviously participate in a lot of committed credit facilities for investment grade corporates, for example, and a number of them have started to include ESG type of questionnaires when they are beginning the process of syndicating or making decisions about who are going to be their relationship banks as well. I think that's a natural extension of the focus we've seen on sort of supplier and supply chain ESG factors, right? If my procurement team is used to doing that every time I'm going to, buy a new ingredient to make my product, for example, it eventually makes its way into an evaluation of all of the partners, including financial.
Yeah, so interesting in terms of a financial supply chain. I don't think we've thought about supply chains necessarily in financial stuff, but here we are. Kedish, what are your thoughts on this? This is good, this is bad. Should we be preferencing green investors and green deals, or just letting the market settle where it is? So
it's an interesting question, because it sort of goes back to an earlier point that I made, that we want to make ESG, we believe that ESG should be part and parcel of your credit analysis. So it's part of a series of inputs that go into the decision to buy or not to buy. And in that context, when we have dedicated accounts which need to buy a certain percentage of sustainable bonds, clearly we're going to be making those portfolio managers aware that this issuance is coming. But in the context of, say, that broad assessment of a risk, and also if that deal is good for those accounts, it's not necessarily going to be purely for those accounts. It could be for a broad selection of accounts at the firm. And as such, it should be made available to those portfolio managers as well. And I don't think it should be regarded as, say, the forbidden fruit sort of concept that only certain people can have it. And I think that's really quite an important point to make, but also it goes back to the thing about making portfolio managers in general aware of ESG. And so the only way to do that is for them to be aware of what the market is doing. And to the idea of diversification of issuance, that also is a good thing. And then that means that, say, more and more issuers are coming to the sustainable bond markets. And that means that, say, it's not the exclusive preserve of, say, dedicated funds. And then to the point about, say, whether or not underwriters should be assessed in their ability to bring ESG labeled bonds, or labeled bonds, let's say, I think that is a credible question to ask. And if you are speaking to an underwriter who is not necessarily the most credible in terms of, say, some of their lending practices, away from the fact that they're leading this deal, then that may not be potentially a positive impression that one gets. But I think it's more about a positive, if you spin it the other way, a company which is an underwriter, which has a credible behavior in terms of its own practices, will itself then have a mindset which will mean it's more credible and able to generate more issuance from this in this area.
Yes, I have always thought that this conversation around pricing tension in books, that the capital markets would work itself out, i.e. that we would get to a place where these huge books would maybe create richer pricing on some of these deals, and some of the funds and orders that were not necessarily needing the green bond might fall out, right? And so that we would get to this place where we wouldn't have to necessarily have special allowances for green investors, or think about clarifying who in this book is green or not green, et cetera. And which brings us to the conversation around the topic of Greenium, the idea that that either green, social, sustainability bonds, sustainability-linked bonds trade at a premium in the market. So I'd love to hear the panel's view on Greenium. We have seen it, especially in some of these larger sovereign transactions where we have clean curves and we can comp to the curve. I'm sure issuers are excited about it. Hopefully that brings us some more supply. But Katish, we'll go back to you on this. You had something you had brought up earlier. The idea of Greenium, is it going to stick around? How much is too much?
So I think the best way to answer it is that the market will tell you what that Greenium is, rather than the investor being told that they should pay more or less for a labeled bond. So it seems to have coalesced around 3 to 5 basis points right now in terms of, and that varies depending on the sector and the type of issuer, but it seems to be in that sort of region. It seems to relatively steady there. To an extent, I think the reason why premiums occur is potentially a lack of supply or lack of issuance, but excess demand, and so that pushes it in that direction. As markets grow, and so as we said, there's potential for $1 trillion from labeled bonds this year. So I think that's one of the reasons why maybe it's not going further negative, i.e. that they trade further and tighter. It's a developing trend. I can't comment as to where, I think it's difficult to comment as to which direction it'll go in, because it's dependent on a number of variables. But one thing I think is true is that the market grows, so it will be dictated by that demand from investors. I don't think it should be, you shouldn't be told this is what you have to pay, if that makes sense.
Yeah. And so, I'll move over to Lisa. I think, one of the interesting things that Fannie Mae does is actually provide cheaper funding, better funding for the borrower for the green assets that you put in your green bonds. I don't remember how much, 18 basis points. So as an issuer, and as you see this Greenium come in, I think it's an interesting concept to think about, how can we pass this on to either the underlying green borrower or the green projects? Any thoughts on this development?
Sure. So I think I would just follow up on Katish's point that it is difficult, right? That is the word I say all the time. We don't stip to a Greenium. We would never imagine telling Katish what premium to pay, but it is really market driven. It varies from day to day. We're out in the market every day with our MBS product, our multifamily MBS product, so we can see a green and a non-green 10.9.5 deal, for example, trade in the market. And yes, occasionally there's a pickup for that green, but is it a pickup because it's green or because it's not in Detroit, instead it's in California, right? There are just too many elements that that go along with commercial real estate to put your finger on saying it is one difference. I would say, it is a supply demand discussion. I think for single family, we're definitely seeing that's a very large market, and we've issued a very small number of green MBS. So I think they're seeing a certain pickup again because of the supply dynamic. But to your point, the incentive that we're giving to the borrowers is really something that we're committing to, right? We've committed to this program, and we've committed to try to make this happen in the greening of our portfolio, right? We think it makes good credit sense, essentially as an insurance provider, right? Which is what our guarantee fee is on these assets. I think it'd be nice to think that you're going to get a Greenium that's going to eventually pay for that. But right now, all we can do is try to incentivize the commercial entities to make these improvements, then to bring them to the market. So I don't want to say it's altruistic, but it certainly is part of our corporate culture and where we think our focus is as an entity. But I don't know that you're ever going to have that point where the Greenium is going to pay for those. And I think Stephen probably has seen this in his issuers, right? That's the question: is, am I going to get enough to pay for this program, or is it going to come out of my pocket?
Yeah, Stephen, what are the conversations like around this?
I mean, it's look, the additional sort of hard dollar costs of setting up one of these programs in the context of a $500 million or $1 billion bond transaction really aren't that big, right? So if like when we run sort of break-even math, okay, if I'm going to set up this program, here's the equivalent number of basis points that I might need to get in Greenium in order for my program to have an economic rationale. It's less than a basis point, right? I mean, we're talking about kind of a relatively de minimis number in the context of a large major corporate financing. Different analysis if we're talking about a small private placement, a small municipal issuance, et cetera, right? But in the market that I deal with, the vast majority of my time, it's relatively small. We get the question all the time, what should we expect, right? And we don't pitch this product, Greenium first, if you will, right? I mean, it's more about the softer benefits and the signaling a commitment to sustainability. I like to talk about it as a validation for your sustainability program, either that you're making a financial commitment to hit a certain target in the SLB structure, or demonstrating that you're investing large sums of real money in the use of proceeds structure, and that has important signaling benefits, not just for investors in this transaction, but also in the rest of your debt transactions and even in your equity transactions as well. We do measure it very closely. We're focused on not so much secondary trading levels of Greenium there, which might be of more interest for Ashley and Kedish. But we're focused on primary performance because that's what our issuers are focused on when they're thinking about the analysis. And so we look at, for every ESG themed transaction, the new issue concession that our syndicate assigns to that transaction compared to the new issue concession for all the other deals in the market the same day. And so that's our attempt to kind of normalize for market conditions there. And what we do find is that it's, like Kedish said, like 3 to 5 basis points lower on average. We find that that Greenium grows as credit spreads grow, right? So either at times when credit spreads are higher in the market, the average Greenium is higher, or for issuers that have lower ratings within the investment grade scale anyway, we do see oftentimes higher Greeniums for those names. And then perhaps somewhat intuitively, we also see a slightly higher Greenium on longer duration transactions versus shorter, because they tend to also have longer spreads as you go out the curve.
Great, thank you for that. So
hey, Ashley,
yeah, please go ahead.
I would love to talk to the point Stephen made, because I do think in defense of issuers, it is an extremely expensive process to decide to commit to issuing, not only because it's just the securities that you're issuing, it's also your infrastructure, right? You have to have corporately an ESG process, an ESG, board has to be focused on your ESG. You have to hire professionals. You need to start reporting. You will likely need to start reporting, right, on a regular basis, whether it be SASB or TCFD. There are a lot of requirements in setting that up. And then I would argue, yeah, you're right, from a corporate perspective, maybe it's a little different, but from an asset-backed perspective, if you're going to set up a program where you're going to require the rigor that makes Keddish happy, right, for the in-place renovation program, again, you're hiring third parties, you're doing energy audits. We pay for energy audits on our assets. We require third-party oversight so that then Keddish feels comfort from the numbers that we're able to give him. So I do think I don't want to soft pedal how expensive or how much of a hurdle it is to enter this market. And so I think there are some things that issuers who are contemplating it should consider.
Yeah, so a couple basis points can help pay for some of that, I would imagine.
I should definitely comment. I mean, that I was trying to speak specifically to like hard costs, but the softer cost of people's time and energy to execute these transactions is genuinely huge. I mean, we've worked with issuers for 6 months, meeting regularly to put programs in place to identify the right assets, work with them to develop the tools to track it. I mean, it is a very involved process. It just tends to be people that already are working there, so it's a kind of allocation of time as opposed to incremental dollars.
Definitely,
So
and I would
totally
say
agree. Should not minimize the work to put these in place.
And I think hopefully future issuers are listening to this and realizing that assets like Stephen and having a broker dealer that can be a partner in that process is invaluable and cheaper. So please take advantage of it.
So I guess that we'll round out to, I think, the final thing that I wanted us to touch on. This idea, Lisa, you're talking about the corporate sustainability framework that has to be put in place. How we think about these use of proceeds bonds in the context of some of the sectors out there that are in transition. And so when we think about evaluation of the ESG criteria, are we more focused on the issuer in general? Are we more focused on the use of proceeds? Can a company that doesn't have a transition plan issue a good green bond? What do we feel about some of the newer issues we're seeing, especially in the oil and gas space? Coming to the market, even with good green bonds around renewables. So how do we balance that that view of the parent versus the use of proceeds? Maybe Keddish, I'll let you kick it off.
So it sort of circles back to some earlier comments that were made, is by all three of us, I think, and yourself as well, is that it does boil down to the credibility of the issuer more than anything else. So use of proceeds is the avenue for, is the way that, say, green bonds, social bonds work. And that means that, say, with the best will in the world, if the framework from the issuer is credible, but the issuer is itself not necessarily aligned towards the sustainability outcomes, then it becomes more challenging to buy that bond. And it's very much, say, it's not business as usual, but issuing something to fund a project doesn't persuade us that that's an investable bond. And I think that's what drives our thinking on this. It's very much a case of, is there a material change happening? It's not business as usual. Does this fit in the context of, say, a behavioral shift? And I think to your point about, say, transition, not everyone has a use of proceeds. And sorry, I'm repeating myself a little bit here. A use of proceeds outcome which is credible. So they then need to think about, say, doing a sustainability linked bond, which is effectively equivalent of a transition financing. And then that means that your business is moving in the direction more aligned towards sustainability. Hopefully that answers that.
Yeah, thank you. And Stephen, and so we call the hard to abate sectors. Are you seeing a pickup of interest in sort of entering this market and signaling their transition plans?
Yeah, I mean, I would say yes. I think there's been interest in it for quite some time, honestly, though, because I think those harder to abate sectors have been the subject of pressure from ESG focused investors and engagement both on the fixed income and equity side for a long time. And so there's been, an attraction to being able to, demonstrate, have that proof point that I referenced earlier of their, transition commitment. I think the climate transition finance handbook that, we've all worked on and helped to develop is a great tool and guidance to help issuers in those sectors think about whether or not their overall corporate sustainability program and transition plan is aligned with what investors in this market would expect and want to see to have a well-received, I'll call it use of proceeds transaction, but also, I think that it also, of course, applies in the sustainability linked format as well. I do think that the sustainability linked format has probably drawn a little bit more attention from the issuers in that space because they have investments they're making that will help to reduce their overall carbon footprint, but might not have investments that would explicitly align with a green bond principles use of proceeds category. I think that'll continue personally.
Yeah. And Lisa, when we talk to your investors, are you finding that as well? It's more interest, also in your green bonds, but then needing to understand your sustainability story?
No, definitely. I think when we first started this, it was enough to just have the green bond issuance program, and there wasn't a lot of look through. But then as the program matured and as investors became more savvy, we were getting kind of unsolicited third-party ratings of the company itself and feedback from investors on those ratings. So we, again, had to grow and mature and understand what the implications were. So I think you'll see more and more. Now we're at the stage where, the word is out. Everybody really realizes that as an issuer, it's not just your asset back that you're issuing, it's also you as an entity. And so I think you'll see just a rising tide of performance from companies as they try to navigate that.
Great. Well, I want to thank our panel for giving us this time today and all these really insightful comments. That's all we have time for today's webinar. And thank you so much for joining our virtual event.